Something is wrong with the silver market. Not wrong like a bad trade or a down week. Wrong like the kind of wrong that happens right before everything changes. And if you've been watching silver for any length of time, you already feel it. You can't quite name it, but it's there. That quiet unease when the numbers don't add up. When the price drops on days it should be climbing. When the news says one thing and the market does another. That feeling isn't paranoia. That feeling is pattern recognition. And today, we're going to follow that pattern all the way to its conclusion. $1,000 silver. Not as a dream, not as a fantasy for people who wear tin foil hats, but as a mathematical outcome that a very specific group of people have already prepared for. The question isn't whether it happens. The question is which side of that event you're standing on when it does. Let's start with what most people get wrong about silver. They think of it as a poor man's gold, a cheaper alternative for people who can't afford the real thing. That framing is not an accident. It was constructed deliberately over decades to keep retail investors underweight in the one asset that sits at the intersection of monetary history and industrial necessity. Silver is not gold's little brother. Silver is the most strategically important metal on the planet right now. Gold stores value. Silver builds the future. Every solar panel, every electric vehicle, every missile guidance system, every semiconductor, every medical device. Silver is inside all of it. And here is the problem that nobody in mainstream financial media wants to say out loud. We are running out of it. Not slowly, not gradually. The deficit between how much silver the world produces and how much the world consumes has been widening every single year. In 2020, it was manageable. In 2021, it grew. In 2022, it exploded. In 2023 and 2024, the numbers became genuinely alarming to anyone paying attention at the institutional level. Above-ground silver stockpiles that used to last years are now measured in months. And yet the price on your screen, the number that COMEX publishes every morning, still moves like none of this is happening. That is the first thing you need to understand. The price you see is not the price of silver. It is the price of a paper contract that claims to represent silver. There is a difference, a fundamental, civilization-level difference. The COMEX system was designed in an era when paper promises and physical reality were close enough that the gap didn't matter. That era is over. Today, there are estimates, conservative estimates from analysts who have no incentive to exaggerate, suggesting that for every ounce of physical silver that actually exists in deliverable form, somewhere between 100 and 500 paper contracts have been written against it. 100 to 500. Let that number sit with you for a moment. If even a small percentage of paper silver holders ever demanded physical delivery at the same time, the entire pricing structure would not bend. It would break. Completely. Overnight. And here is where it gets interesting, because that scenario, the one that breaks the paper market, is no longer theoretical. It is already beginning, not with retail investors, not with Reddit forums or YouTube channels or people who found silver 6 months ago. It is beginning with the entities that move real weight. Central banks in the Eastern Hemisphere have been accumulating physical precious metals at a pace that has no modern precedent. China's Shanghai Exchange has been quietly settling contracts in physical metal while simultaneously restricting silver exports. Industrial users, the manufacturers, the defense contractors, the solar panel producers, are starting to secure supply contracts years in advance because they are genuinely worried about availability. These are not emotional decisions. These are logistical decisions made by procurement teams who understand that if silver is unavailable at any price, their production lines stop. And when the people who actually need silver start competing with the people who want silver as a monetary asset, the paper price ceiling does not hold. It cannot hold. The math will not allow it. The people who are going to get wiped out are not stupid. That is the most important thing to understand about what is coming. They are not ignorant. They are not careless. They are simply operating on information that is 2 cycles behind where the smart money already is. And by the time the information catches up, by the time the headlines confirm what the data has been screaming for months, the position will already be closed. The opportunity will already be gone. This is how wealth transfers actually work, not through crashes, not through panics, through the quiet, methodical repositioning of capital by people who understood the thesis before it became consensus. Right now, there are 2 groups of people in the silver market. The first group holds paper, ETFs, futures contracts, allocated accounts at banks that haven't been audited in years. They believe they own silver because a statement says they do. They sleep well, they feel positioned, and in a stable world, they would be fine. But we are not in a stable world. We are in a world where the underlying asset their paper claims to represent is being physically removed from the system faster than it is being replaced. Every month that passes, every industrial contract that gets signed, every central bank that adds to its physical reserves, the gap between what the paper promises and what actually exists grows wider. These people do not know they are holding a claim on something that may not be there when they go to collect. The second group holds physical, not because they are survivalists or doomsday preppers, but because they did the analysis, followed the supply chain data, looked at the deficit numbers, and reached a conclusion that the paper market has not yet priced in. These are the people who will benefit, not because they got lucky, because they were early. And in markets, being early and being right is the most powerful combination that exists. Now let's talk about the mechanism, because $1,000 silver does not happen through optimism. It does not happen because people feel good about the economy. It happens through a very specific sequence of events that the data suggests is already in motion. First, industrial demand continues to outpace supply. This is not a forecast. This is a current reality. The solar industry alone is consuming silver at a rate that would have seemed impossible 10 years ago. One high-efficiency solar panel uses approximately 20 grams of silver. The world installed over 400 gigawatts of solar capacity in recent years. Do that math slowly, then add electric vehicles, then add defense spending, then add the medical sector, then add every emerging technology that requires conductivity, reflectivity, and resistance to corrosion that no synthetic material has been able to fully replicate. Second, mining output is not keeping pace. The easy silver deposits were found long ago. What remains requires deeper drilling, more complex extraction, higher energy costs, and longer permitting timelines. New mines take 7 to 10 years from discovery to production. The silver that the market will need in 2027 and 2028 should already be in the ground being extracted right now. It is not. The pipeline is thin in a way that should be generating daily headlines, but instead generates almost no coverage at all. Third, and this is the piece that accelerates everything, confidence in the paper system begins to crack. It does not need to shatter completely. It only needs to crack enough that a meaningful percentage of paper holders decide they want the physical metal instead of the promise. When that happens, the hunt for real silver begins. And the price discovery that follows will have nothing to do with the number on your trading screen this morning. The people who get wiped out will not lose because they made an irrational decision. They will lose because they trusted a system that was built for a different era and never updated its assumptions. They held the paper version of an asset in a world that was quietly, systematically converting to physical. And by the time they realized the difference mattered, it was already too late to make the switch at a price that made sense. Here is what nobody wants to say in public. The $1,000 silver scenario is not the extreme outcome. It is the conservative one. The extreme outcome is what happens if the paper market does not have an orderly unwind. If instead of a gradual repricing, you get a sudden, disorderly recognition that the contracts outstanding cannot be honored in physical metal. In that scenario, the question is not what price silver reaches. The question is whether a price can even be established in the traditional sense. Because when supply is genuinely constrained and demand is genuinely urgent, price becomes almost secondary to access. The people with physical silver will not be selling it at any price the current market would recognize as reasonable. They will be setting their own terms. But let us stay in the conservative scenario because that is the one that is already unfolding. The conservative scenario says that over the next several years, the cumulative weight of the supply deficit, the industrial demand surge, the Eastern accumulation of physical metal, and the gradual erosion of confidence in paper instruments creates a sustained repricing of silver that moves it from its current level toward a number that, today, sounds extreme, but mathematically represents nothing more than fair value given the actual supply and demand fundamentals. Consider gold for a moment. The gold-to-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has historically averaged somewhere between 15 and 30. That ratio reflects the natural abundance of each metal in the Earth's crust and the historical monetary role each played. Today, that ratio sits above 80. In some recent periods, it has pushed past 90. What that means, in plain language, is that silver is historically cheap relative to gold by a factor of 3 to 6 times, depending on which historical baseline you use. If gold is at $3,000 and the ratio normalized to even 30, not 15, just 30, silver would be at $100. If gold moves to $5,000 and the ratio normalized to 20, silver would be at $250. And if you layer on top of that the industrial demand premium that has no historical equivalent because there was no solar industry, no EV industry, no semiconductor industry at scale in any previous silver bull market, the $1,000 number stops looking like speculation and starts looking like arithmetic. This is the part that the mainstream financial conversation consistently fails to incorporate. Every previous silver bull market was primarily a monetary event, people buying silver because they didn't trust fiat currency. This one is something different. This one is a monetary event sitting on top of an industrial event sitting on top of a supply crisis. 3 separate demand drivers converging on one asset at the same moment that supply is structurally constrained. There is no historical template for this, which means there is no historical ceiling that applies. The institutions that understand this are not talking about it publicly. Why would they? Every time retail attention moves into silver, it becomes harder and more expensive for large buyers to accumulate at reasonable prices. The smart approach is to build the position quietly, let the paper market do its job of suppressing the narrative, and wait. The waiting is almost over. The signals coming out of the physical market, the premiums on retail silver, the delays in delivery, the tightening of lease rates, the shift in Eastern exchange behavior, are the early indicators of a system that is approaching its limits. And when systems approach their limits, they do not slow down gracefully. They accelerate toward the breaking point. The people who will benefit from $1,000 silver are already positioned. They did not wait for permission from CNBC. They did not wait for an analyst upgrade or a Fed statement or a mainstream consensus. They looked at the data, understood what it meant, and acted before the crowd arrived. That window is not fully closed, but it is narrowing. Every week that the paper price holds the line is a week that physical silver gets harder to find at that price. The divergence between paper and physical is itself the signal, and that signal is getting louder. So where does this leave you? Not as a trader, not as someone looking for a quick move, but as someone who is trying to understand what is actually happening in the world and make decisions that protect what you have built. The answer requires honesty about something most financial content will never say directly. The system you were taught to trust, the one with regulated exchanges and audited inventories and institutional oversight, That system has a structural vulnerability that has never been stress tested at the scale it is about to face. And the people inside that system, the ones who built it and profit from it and depend on it for their credibility, are not incentivized to tell you where the cracks are. Silver at $1,000 is not a gift. It is a symptom. It is what happens when a price suppression mechanism meets an immovable physical reality, and the physical reality wins. The winners in that scenario are not people who speculated correctly. They are people who understood the difference between owning an asset and owning a promise, between holding something real and holding a document that says something real exists somewhere. That distinction, which sounds philosophical in a stable environment, becomes the most practical question in the world when the system is under stress. The question you need to ask yourself is simple. If tomorrow the paper-silver market experienced the kind of dislocation that the supply data suggests is mathematically inevitable, if the ETFs suspended redemptions, if the futures exchanges declared force majeure, if the allocated accounts at major banks suddenly had qualification language that prevented immediate withdrawal, what would you actually own? What would be in your hand? What would be yours without counterparty risk, without system dependency, without the cooperation of an institution that may be facing its own crisis at the same moment you need it most? This is not a question designed to frighten you. It is a question designed to clarify. Because clarity, in a market that runs on confusion, is itself a form of protection. The people who get wiped out in the $1,000 silver scenario will not lose in a dramatic moment. They will lose in the quiet administrative aftermath, the redemption queues, the settlement delays, the force majeure clauses buried in documents they signed without reading, the legal distinction between allocated and unallocated that their broker never explained clearly. The mechanism of loss will be bureaucratic, but the result will be the same. The people who benefit will wake up that morning holding something that the market has finally decided to price correctly, something they acquired when the consensus said it was unnecessary, something that the data said was undervalued by any rational measure, and they will not celebrate loudly, because people who understood this thesis from the beginning understand that $1,000 silver is not a victory for silver investors. It is a signal that something larger has broken. And when large things break, the goal is not to win. The goal is to still be standing, to have preserved enough of what you built that you can navigate whatever comes next from a position of stability rather than desperation. Silver at $1,000 will happen because the math demands it. The only variable is time, and the only choice available to you right now is which side of that event you want to be on when the math finally wins.